DRIP ETFs, harnessing the power of compound dividends in exchange-traded funds. In the realm of investment strategies, few things can rival the potent combination of dividend reinvestment and diversification. While dividend-paying stocks have long been lauded for their steady income streams, managing a portfolio of individual companies can be time-consuming and expose investors to single-stock risks. This is where Dividend Reinvestment Plan, DRIP, ETFs step onto the scene, offering a unique blend of passive income generation and diversified exposure within the convenient wrapper of an exchange-traded fund, ETF. Understanding the DRIP in DRIP ETFs. Before diving into the intricacies of DRIP ETFs, it's crucial to demystify the concept of dividend reinvestment itself. A DRIP, in essence, automates the process of reinvesting all received dividends back into the underlying asset, typically buying fractional shares to compound wealth over time. This compounding effect is akin to a snowball rolling downhill, growing larger with each additional dividend payment. DRIP versus individual stock DRIPs. While traditional DRIPs for individual stocks offer the advantage of focusing on specific companies, they also come with drawbacks like administrative burdens and exposure to single stock volatility. DRIP ETFs address these concerns by 1. Providing instant diversification. A single DRIP ETF can hold hundreds of dividend-paying companies across various sectors and industries, mitigating single-stock risk. 2. Simplified administration. Investors avoid the hassle of manually reinvesting dividends or navigating fractional share purchases. 3. Lower minimum investment. DRIP ETFs allow for smaller initial investments compared to building a diversified portfolio of individual stocks. 4. Tax efficiency. Certain DRIP ETFs reinvest dividends through in-kind transactions, deferring the realization of capital gains and potentially lowering tax liabilities. Types of DRIP ETFs. The universe of DRIP ETFs encompasses a diverse range of strategies, catering to various investment goals and risk tolerances. Some popular categories include 1. High dividend DRIP ETFs. These focus on maximizing current income by tracking indices or selecting stocks with historically high dividend yields. 2. Broad market DRIP ETFs. These offer diversified exposure to established companies across diverse sectors, providing a blend of income and long-term growth potential. 3. Growth-oriented DRIP ETFs. These prioritize companies with strong growth prospects and reinvest dividends into companies with higher dividend growth potential. 4. Thematic DRIP ETFs. These track specific themes or sectors known for strong dividend-paying companies, such as real estate or utilities. Evaluating DRIP ETFs. Choosing the right DRIP ETF requires careful consideration of several factors. 1. Underlying index or investment strategy. Understand the companies held by the ETF and align it with your risk tolerance and investment goals. 2. Dividend yield. While high yields are tempting, prioritize sustainable dividend growth potential and overall portfolio diversification. 3. Expense ratio. Lower expense ratios translate to higher returns for investors, so choose ETFs with competitive fees. 4. Tax implications. Understand the tax consequences of in-kind versus cash dividend reinvestment within the chosen ETF. Strategies for optimizing DRIP ETF usage. DRIP ETFs are powerful tools, but their effectiveness can be further enhanced by 1. Investing consistently. Regular contributions, even small amounts, fuel the compounding effect of reinvested dividends. 2. Choosing a long-term horizon. DRIP ETFs shine over the long term, so avoid frequent trading and focus on steady, patient investing. 3. Rebalancing the portfolio. Periodically review the ETF's holdings and adjust allocations to maintain desired diversification and risk profile. Potential drawbacks of DRIP ETFs. While DRIP ETFs offer numerous advantages, it's essential to acknowledge potential drawbacks. 1. Limited choice. Compared to the vast universe of individual stocks, DRIP ETFs offer a more limited selection of underlying assets. 2. Tracking error. Some DRIP ETFs may not perfectly track their target indices, leading to potential performance deviations. 3. Concentration risk. Certain DRIP ETFs might concentrate holdings in specific sectors or industries, increasing exposure to related risks. Beyond traditional dividends. While classic dividend payments are the staple of DRIP ETFs, some funds employ additional mechanisms to enhance income generation. Covered call strategies. Some DRIP ETFs utilize covered call options, generating additional income by selling call options on their underlying holdings. This can result in lower capital appreciation compared to traditional DRIP ETFs, but offers a more consistent income stream. Focus on total return. Certain DRIP ETFs prioritize total return through a combination of dividends, capital appreciation, and potential option strategies. These offerings cater to investors seeking a more multifaceted income and growth mix. Emerging markets and global opportunities. While many DRIP ETFs focus on established domestic markets, the world offers a wealth of dividend-paying companies. Some considerations when exploring international DRIP ETFs include emerging market exposure. These ETFs offer access to high-growth economies with potentially higher dividend yields, but carry higher political and economic uncertainties. Currency considerations. Fluctuations in foreign currencies can impact returns, requiring careful risk assessment and diversification strategies. Tax implications. International dividend taxes and reporting requirements may differ from domestic investments, necessitating professional guidance. Tax optimization strategies. Understanding the tax implications of DRIP ETFs can significantly impact your net returns. Some key points to consider. 1. In-kind versus cash reinvestment. Some DRIP ETFs reinvest dividends through in-kind transactions, deferring capital gains realization until shares are sold. This can be tax efficient for long-term investors. 2. Qualified versus non-qualified dividends. The tax treatment of dividends varies depending on their qualification status. Understanding these nuances can help minimize tax liabilities. 3. Seeking professional advice. Complex tax scenarios involving DRIP ETFs may benefit from the expertise of a financial advisor or tax professional. The role of technology and innovation. The world of DRIP ETFs is experiencing a wave of innovation, with technology playing a crucial role in optimizing and democratizing these investment vehicles. 1. Robo-advisors. Automated investment platforms are increasingly incorporating DRIP ETF strategies, enabling personalized portfolio construction and automatic dividend reinvestment. 2. Fractional share investing. The ability to buy and sell fractional shares makes DRIP ETFs more accessible to investors with smaller portfolios. 3. Thematic and niche ETFs. The emergence of ETFs targeting specific sectors, industries, or dividend characteristics provides investors with granular exposure to tailored income streams. Beyond the hype, a realistic perspective. While DRIP ETFs offer compelling advantages, it's crucial to maintain a realistic perspective. 1. Volatility is inevitable. Dividend-paying companies are not immune to market fluctuations, and DRIP ETFs will experience periodic volatility, requiring a long-term investment horizon. 2. Not a magic bullet. DRIP ETFs are powerful tools, but they don't guarantee success. Careful research, diversification, and ongoing portfolio management remain essential for achieving investment goals. 3. Seek professional guidance. If navigating the complexities of DRIP ETFs feels overwhelming, consider seeking guidance from a qualified financial advisor. Conclusion. DRIP ETFs offer a unique and powerful approach to generating passive income and building wealth over time. Understanding their nuances, employing effective strategies, and maintaining a realistic perspective are crucial for harnessing their full potential within your investment portfolio. By combining the compounding power of dividends with the diversification advantages of ETFs, DRIP ETFs can be a valuable addition to your long-term wealth-building journey.